Hi, and welcome to another Stock Insights video on Stock Market Palantir. Make sure to hit the subscribe button and drop your comments. All right, let's go for the analysis.
186.32. That's the number glaring at us from the screens as of the close of markets mid-January 2026. T-Mobile US is hovering dangerously close to its 52-week lows. But if you think the price action is ugly, you should take a look at the plumbing. The volume and, while the derivatives market are painting a picture that is, it's even more intense. We're seeing this massive spike in short interest. It's risen over 34% in recent reporting periods to approximately, 15.12 million shares. That's roughly 3.41% of the float.
And honestly, the raw number of shares shorted, that isn't even the scariest part. It's the days to cover metric. That has just jumped from 2.83 all the way up to 6.64. For anyone not, glued to a terminal, that means if the shorts had to cover their positions, it would take nearly a full week of average daily volume to do it. That is a significant bearish overhang. It suggests the market isn't just betting on a momentary dip. They're positioning for structural correction. So the central question we have to grapple with today is, has T-Mobile hit a strategic inflection point? Is this simply a temporary sentiment washout and a long-term growth story? Or is the Un-carrier era, mathematically and culturally over?
I think you know where I stand on this. I view this as a classic market overreaction to a leadership transition. The market hates uncertainty, and we have a lot of it right now. But the fundamentals, specifically the structural network advantages, they remain superior to anything AT&T or Verizon can put on the table.
See, I come at it from a different way. I think the valuation premium T-Mobile has enjoyed for a decade is just not justified anymore. The growth narrative is hitting these physical and cultural walls, and the Un-carrier brand that built this valuation, it's being dismantled from the inside out. We're seeing the end of an era, and the stock price is just finally catching up to that reality.
All right, let's get into the positions then. I look at this retreat in the stock price, and I see a buying opportunity. You have to separate the signal from the noise here. The signal is that T-Mobile is still the only true growth vehicle in U.S. telecom. We can talk about sentiment, but let's talk about physics first. The 2.5 gigahertz mid-band spectrum portfolio is a moat the competitors cannot easily cross. We're looking at the January 2026 open signal reports, and T-Mobile is still delivering median download speeds nearly 50% faster than Verizon or AT&T. That is a product advantage that doesn't just disappear because Wall Street is nervous about a CEO change.
But speed isn't the only metric that matters anymore. We're reaching a point of diminishing returns on speed for the average consumer.
It matters when you're still winning the switching game. And I'd argue that the transition from like Sievert to Srinivasan Gopalan isn't a crisis. It's a necessary shift to, let's call it, industrialization. We are moving into the fiber and convergence era. You need an operator, not just a marketer. And regarding that short interest you mentioned at the top, I see that largely as technical. It's a hedge fund pair trade, not a fundamental indictment of the business model.
I'm sorry, but I just don't buy that it's purely technical. The Un-carrier brand was the source of that valuation premium, and that brand is eroding. Just look at the math. TMUS is trading at roughly 20.3 times forward PE. Meanwhile, you've got Verizon and AT&T languishing down at 9 and 7.6 times respectively. That gap is just unsustainable in a maturing market. You can't command a tech growth multiple when you're becoming a utility.
But they aren't a utility yet. They are a growth platform.
They are acting like a utility. The growth narrative is hitting physical limits. Fixed wireless access, which was the darling of the last few years, is reaching capacity limits in urban areas. And the lack of owned fiber makes T-Mobile incredibly vulnerable to AT&T's convergence strategy. But more importantly, the culture shift is palpable. We moved from Sievert, a marketing genius, to Gopalan, an infrastructure operator. And what's the first thing we see? The T-Life app disaster. That is an anti-consumer move that just screams incumbent, not Un-carrier.
Okay, I want to dissect that valuation argument because I think it's the crux of the bear case. And frankly, I think it's flawed. You mentioned the pair trade. Let's unpack that because it explains why the stock is down despite, decent fundamentals.
Right. It's a standard long-short equity strategy.
and it's accelerating. Hedge funds are looking at the telecom sector and seeing this massive disparity. So they go long on AT&T and Verizon, betting on mean reversion because those stocks are historically cheap, and they short T-Mobile, betting on multiple compression. They are effectively betting that T-Mobile is going to be re-rated as a mature incumbent. If T-Mobile drops to a 15x PE, which is still a premium over Verizon, you're looking at a 25% drop in the stock price. That is the valuation trap.
I see why you think that, but let me give you a different perspective. That trade assumes that T-Mobile is a mature incumbent. I reject that premise. T-Mobile is not a dumb pipe utility yet. It still leads the industry in churn management and net adds. Verizon and AT&T, they're value traps. Sure, they're cheap, but they have low to no growth. You buy T-Mobile because the capital appreciation upside is still there. Buying a dying business because it's cheap is not a strategy. It's catching a falling knife. Buying the leader during a dip, that's investing.
But is the upside there when the cost of capital has fundamentally changed? I mean, we aren't in the zero interest rate environment anymore. T-Mobile is carrying approximately $120 billion in debt.
Which is significantly less than Verizon or AT&T, and their maturity profile is better managed.
True. The T-Mobile is pivoting to a capital-intensive fiber strategy. Investors are punishing the lower return on invested capital, ROIC, that's associated with digging trenches for fiber. When money costs money, you can't just promise growth at any cost. You have to deliver efficiency. And the market is saying that at 20 times earnings, T-Mobile is priced for perfection in an environment that is far from perfect. It's the priced for perfection problem. If they miss earnings by a penny, or if churn ticks up by a single basis point, the algorithm just hammers them.
Price for perfection is a fair critique, but I would argue they are delivering near perfection operationally. The noise is mostly external or transitional.
Is it though? That brings us to the internal environment. You sort of laid the blame for the recent sentiment shift at the feet of the new leadership. I think that's a bit uncharitable to Srinivasan Gopalan, but, well, the facts are the facts.
Gopalan has been in the seat for barely a minute in corporate time.
And look at the damage? Let's look at the Tree Life app launch. This is the first major product move under the new regime. It was intended to be a digital transformation milestone, a super app to rival what we see in Asia. Instead, it has been a public relations disaster. They removed human support channels to force adoption, retail staff are being pressured to install it on customers' phones, and the privacy scandal? I mean, users finding screen recording permissions in the code? That is the antithesis of the uncarrier. That is something a monopoly does because they know you have nowhere else to go.
Look, I'm not going to defend the bugs in an app launch. Every digital transformation has hiccups. But look at Gopalan's background. In Germany, he oversaw a massive fiber-to-the-home expansion, passing 2.5 to 3 million homes annually. That is the skill set T-Mobile needs right now. The T-Life backlash is short-term noise. It's a friction point, sure, but it's part of moving the customer base to a more digital, efficient model. You cannot scale a customer service model based on phone calls when you have 100 million customers. You have to digitize.
But it's not just friction. It's a violation of the brand promise. Sentiment analysis is showing that 75% of customers feel the company is moving too fast and ignoring their privacy. And let's talk about continuity. The bullish argument was that Mike Sievert is still there as vice chair. But practically speaking, Sievert moving to vice chair removes the marketer-in-chief from the daily operations. The culture is shifting from an agile, Bellevue-based startup to a bureaucratic subsidiary of Deutsche Telekom. It feels like the suits have finally taken over.
I think you're overestimating the culture impact and underestimating the execution impact. Gopalan is an executor. And frankly, Sievert is still in the room strategically. But let's pivot to the actual product, the network. Because all the marketing in the world doesn't matter if the call drops. And this is where the bull case is strongest.
I was waiting for you to bring up the spectrum again. You love the spectrum argument.
Because it matters. It's the laws of physics. Verizon's C-band propagates less well than T-Mobile's 2.5 gigahertz. That is a physical reality. It means T-Mobile needs fewer towers to cover the same area with mid-band 5G. That is a permanent capital efficiency advantage. Competitors cannot fix the laws of physics. They can build more towers, sure, but that costs billions. T-Mobile has already won the geography.
Physics is great, but reliability is better. We have to talk about January 14th, 2026, the network outage.
It was technically distinct from Verizon's failure that same day.
But it happened. T-Mobile blamed an IP traffic storm and routing instability. That phrasing is terrifying for enterprise clients. If you're trying to sell business-class reliability to Fortune 500 companies, which is Gopalan's main growth target, you cannot have routing instabilities. That outage damages the credibility of the entire enterprise strategy. You can't tell a hospital or logistics company we have better spectrum if the routing fails.
It was a singular event in a context where Verizon also failed. It highlights a grid fragility issue, not a T-Mobile-specific incompetence. But let's talk about the future, the fiber strategy. You mentioned fiber FOMO.
It is FOMO, fear of missing out. T-Mobile is late to fiber. They are scrambling to sign joint ventures with Metronet and Lumos because they don't have the owned assets. This dilutes the whole capital-light narrative. You're relying on partners. Meanwhile, AT&T owns the glass in the ground. And fixed wireless access, it's a fill-in product. It can't scale indefinitely in dense cities without clogging up the mobile network. You're already seeing speeds drop in urban centers during peak times because the FWA users are hogging all the bandwidth.
I completely disagree with the framing of the joint ventures. The JV model is smart capital allocation. It keeps that heavy debt load off T-Mobile's balance sheet while still gaining access to the fiber footprint. It allows them to bundle without destroying their ROIC. It's not late, it's smart. They are letting others dig the holes while they sell the service. Why own the dirt if you can just own the customer relationship?
Because if you don't own the dirt, you don't control the economics. Renting access works until the landlord raises the rent. It's smart accounting, maybe, but it's strategically weak. But speaking of control, we need to address the elephant in the room. Or rather, the German giant in the room, Deutsche Telekom.
The SoftBank overhang is gone? That's a positive. We have stability now.
We have domination. Deutsche Telekom has majority voting control, over 50.1%. T-Mobile US is effectively a piggy bank for DT's European operations. Look at the capital allocation, dividends, and a $14.6 billion buyback program.
Which returns cash to shareholders. That's a good thing. A buyback at these levels is accretive.
It returns cash to one specific shareholder primarily. As buybacks shrink the float, DT's percentage of control tightens even further without them spending a dime. And concurrently, we see DT selling small tranches of shares under Rule 10b 5-1. They are monetizing the asset to pay down their own leverage in Europe. This creates a persistent supply pressure. The stock can't break out because the parent company is essentially capping the upside. Every time the stock rallies, DT sells a block.
I think characterizing it as a piggy bank is hyperbolic. DT has every incentive for T-Mobile US to succeed. It's the most valuable part of their portfolio. They aren't going to kill the golden goose. The buybacks support the stock price for everyone, not just DT. And the selling is programmed, it's predictable. The market can absorb it.
They won't kill it, but they will milk it. And that changes the investment thesis. You are no longer investing in a high-growth insurgent. You are investing in a subsidiary of a European legacy carrier. The incentives are aligned with DT's balance sheet, not necessarily with the T-Mobile US minority shareholder.
I hear you, but the operational engine is still American and it's still running hot. So let's try to synthesize this. Despite the noise about apps and leadership, T-Mobile remains the operational leader. They have the best network assets. That 2.5 gigahertz spectrum is the gift that keeps on giving. The current price, hovering near 186, is a buying opportunity. The market is pricing in a crisis that doesn't exist. We are simply seeing a company transition from insurgent to dominant leader. That transition is messy, I'll grant you, but the destination is profitable.
That's a compelling argument. But have you considered that the messiness is actually a signal of decay? The easy growth is gone. The combination of the T-Life sentiment crash, the leadership shift to a metric-driven bureaucratic culture, and the looming valuation compression makes the stock a hold at best. There is a real risk of the stock re-rating to, say, $150 if that multiple contracts. The uncarrier magic was about defying gravity. Now, gravity is taking over.
Gravity applies to everyone, but T-Mobile has a better parachute, or rather, a better engine with its spectrum depth.
We will see if that engine can outrun the weight of the valuation.
And this really brings us to the innovator's dilemma, doesn't it? It is incredibly difficult for a company like T-Mobile to mature without losing that magic that made it successful in the first place.
Exactly. They disrupted the industry, but now they are the industry. The things that made them special, human customer service, simple plans, and an irreverent brand, are being stripped away in the name of efficiency.
Or they're evolving. You can't be a startup forever. But the question for investors is whether T-Mobile can survive the rotation from a growth stock to a value stock without a painful correction.
And whether the uncarrier is dead or just growing up. I suspect the market will spend the rest of 2026 figuring that out.
It certainly will be the story to watch. That's all the time we have for today.
Thanks for listening.
If you found this video interesting, don't forget to subscribe to the Stock Market Palantir channel for more. Thanks for watching and see you next video. Bye-bye.